welcome back, everybody. The stock futures this morning are relatively muted to start the trading week. You've got the Dow futures off by about 35 points right now. And joining us to talk about what he's seeing in the markets right now is Tom Lee. He is Fundstrat Global Advisors managing partner and a CNBC contributor. Tom, it's weird. We are sitting very near all-time highs, and yet it does feel like there is some nervousness in the market at this point. A lot of this is coming from hotter than expected inflation numbers, stronger than expected jobs reports, and manufacturing numbers, the ISM, that was better than anticipated too. That's got people wondering if the Fed is actually going to be able to cut rates this week. Are you unnerved by any of this?
I think this coming Wednesday, Becky, will really answer a lot of questions because I think you've summed up well. Investors have been grappling with this idea that can the Fed be in a position to, reduce real rates if we've got good economic growth? Because what does that mean for inflation? And this coming Wednesday is March CPI. I think it's going to be the first clean CPI report of this year. It won't have any residual seasonality. We're expecting that to be a pretty good report, lower than expected inflation. And I think it's going to help investors get to this place where we can have pretty good growth in the economy. There's some slack in the labor markets, but inflation's falling fast enough for the Fed to actually cut rates this year. And of course, that'd be great for stocks.
I know you'd been telling people kind of buy on the dip, not that there's been much of a dip if you're just talking about a pullback of a few percent. Does it matter if the Fed cuts rates or not? If the economy's really strong anyway, will earnings be able to justify the valuations at this point?
I think the Fed being supportive of the economy, so managing the business cycle, is the most important thing. In the last 2 years, the Fed was fighting inflation and therefore hawkish. That was tough for equities. But if we're in a mode where the Fed doesn't know how many cuts it needs to make, but it actually wants to support the business cycle, that's good for stocks. So I don't think you need to have 3 rate cuts. You could even have a good scenario where the Fed only cuts once. But if the Fed's in a position where they feel they need to actually raise interest rates, that'd be bad for stocks.
Hey, Tom, hold on just a moment. We've got some breaking news. We'd actually like to get your reactions, if you don't mind listening in.
We just have some news literally crossing this moment, which is that Jamie Dimon's JP Morgan is publishing his annual letter to shareholders. And we want to bring you some of the news that's in this letter, a highly watched letter annually. Dimon writes the following. He says that despite the, quote, unsettling landscape, war in the Middle East and Ukraine, growing geopolitical tensions in China, and polarized electorate here in the U.S., that the U.S. economy, he thinks, continues to be resilient with consumers still spending. He says the market seems to be pricing in a 70 to 80% chance of a soft landing, but Dimon thinks the odds are, quote, a lot lower. He cites persistent inflationary pressures, including what he says are, quote, ongoing fiscal spending, remilitarization of the world, restructuring of global trade, and capital needs of the new green economy. Another major theme in the letter is artificial intelligence. Dimon writing that the consequences will be extraordinary. He says JP Morgan Chase has grown its AI organization, quote, materially, with more than 2,000 machine learning experts or data scientists now on the payroll. Dimon also issuing a warning, quote, we may be entering one of the most treacherous geopolitical eras since World War II. He said he's also concerned about the large deficit supported by quantitative easing. I will say on the World War II piece, he says, when terrible events happen, we tend to overstate or overestimate the effects that they will have on the global economy. Recent events, however, may very well be creating risks that could eclipse anything since World War II. We should not take them lightly.
And that's the risk manager side of him.
Right.
But it's interesting. Jamie Dimon, I think, is somebody who's always been fairly optimistic about the United States and the economy. His concern about some of these geopolitical events is one that is echoed by other people who are generally pretty optimistic about things. If you talk to a Warren Buffett or someone too.
The letter generally, I should say, is what I would describe as cautiously optimistic. Yeah, I think tonally we just hit on what I would describe as the news pieces in the letter.
Right.
But I think tonally it's an upbeat letter. He's talking about AI. spends a bit of time. This is 20 years now, 20-year anniversary since the bank won JP Morgan Chase deal, which actually put him in charge of the company. Talks really about the growth of the bank. It's now the largest bank by market cap in the country. Goes through a whole number of other pieces to it, management lessons and other things. It is a worthy read, by the way.
There's only a few CEOs who actually really write their own letters without worrying about lawyers and lots of other people going through it, reading it and telling them what they can say, what they can't, actually writing it for them in a lot of cases. I mean, Jamie Dimon, obviously a huge one, Warren Buffett, Jeff Bezos always wrote a very straightforward letter from that you could tell was written by him with their voices. I think Larry Fink's letter this year was up there with that, where about his parents at the very top of the entire letter. That's why these letters are so interesting, and I think the tone and his tone on the markets is one that he's been kind of consistent about over the last year or so, and that is the concern about a soft landing not necessarily being as certain as the market expectations seem to be, and concern about higher inflation. And maybe we're going to ask Tom about that right now.
Tom's been the bull, though. Yeah. Tom's been on the other side of this, Tom. What do you think?
I think Jamie's doing his shareholders justice because they want to hear from him about all the concerns out there. I think he does a great job of detailing all the things that could go wrong. But at the end of the day, when it comes to markets, I think markets tend to price concerns very quickly. I mean, I think that's really been the concern for the last 2 years is a hard landing. And now that inflationary pressures are easing at a time when consumers don't have a lot of leverage, there's all this, there's $6 trillion cash on the sidelines. And inflation, we don't really know how quickly it's going to fall, but our bet at Fundstrat is that it's going to fall pretty quickly, means some of the concerns he listed about a hard landing are because of sticky inflation. And if it's softer, I think we're going to have quite a good economy.
Is this a two-pronged outlook on the economy and the markets, though, Tom? Is inflation the one big issue? And if Wednesday proves that it's a hotter than anticipated or hotter than expected CPI number, would you change your ideas about what that means for both of those things for the long term or for the year?
That's right. I think if inflation, because March's going to be the first clean CPI report. We know out of Europe, they've come in pretty soft. They've come in better than expected. If it comes in higher than expected, then I think it raises the question that the inflation is quite stubborn, and getting to that from 3 to 2 is going to be difficult. On the other hand, if it is a soft report and we think it's the probabilities favor below a 0.3, that's consensus core 0.3, I think it's going to change a lot of people's minds that inflation may not be that stubborn.
Yeah. You have been telling people to buy, or you yourself have been buying on any dips. And by dips, we're not talking 5 or 10% drops. You're talking 2% drops, and you'd be buying into the market?
That's right. I think that there's many reasons that we still think there's gas in the tank in this rally. Part of it is that we do think the inflation trajectory is on a glide path lower than consensus expects. The second is I think there's too much caution out there. When you look at prime brokerage borrowings, or basically leverage in the market, it's still below where it was in October 2021. There's still $6 trillion cash on the sidelines. In our conversations with clients, they're still quite cautious. So as long as investors are top calling and are really looking at the world half empty, I think stocks can still rise on this wall of worry.
Tom, just the idea of that, I mean, that's a pretty bold call, and I think it's a big deal. We are trying to be data dependent and figure out where inflation's headed. What makes you think that it's lower than the market is necessarily, or maybe some of those who are most concerned about the market are raising issues about? What do you look to in terms of your expectations and your read on inflation?
Well, I think that it really comes down to 2 basic frameworks that we have. Number one is that when we look at year-over-year core CPI, 2.4 is where it averaged 20 years before the pandemic. It's roughly 1.4 percentage points above that, so roughly 3.8. Of that, 1.8 percentage points is just shelter and auto insurance. Shelter is statistically going to start to actually ease this year because of the catch-up. And auto insurance is also statistically going to ease because it's mainly a catch-up. So core inflation ex auto insurance and housing is actually below the Fed's target. The second issue is that January and February tend to suffer from both statistical aberrations and residual seasonality. That's why the first 2 months of every year have bad, essentially tough CPI. That's going to disappear in March. I think we're going to get our answer on Wednesday, but I think it's going to look quite good.
A lot of anticipation ahead of that number on Wednesday. Tom, thank you so much for joining us and for rolling with that breaking news, too.